Welcome to the Stock Market Palantir. Today we are going to talk about QBTS, D-Wave Quantum Inc. It's arguably the most recognizable name in the nascent, high-stakes quantum computing sector. It's uniquely positioned with its commercial quantum annealing systems running alongside, the development of its gate model architecture.
But what has captured and frankly terrified the market recently is the sheer, brutal volatility we saw in late November 2025. The stock plummeted from highs near $45 down into the low 20s in just a matter of weeks.
Exactly. And the central question arising from this market action is fundamentally pretty simple, but it's deeply complex in its implications. Is this precipitous decline a justified reckoning, rooted in inherent structural market risks and critical insider signaling?
Or conversely, is this volatility just a temporary mechanical correction that's currently obscuring a story of genuinely accelerating commercial growth and a necessary capital structure cleanup?
Well, I believe the market has overreacted to technical noise. I'm going to argue that QBTS is successfully navigating a crucial maturation phase, driven by powerful operational execution and a decisive move to stabilize its capital structure.
And my concern, conversely, is that the price action is fundamentally dominated by story stock dynamics, severe structural selling pressure, and a deep crisis of confidence. A crisis driven by an untenable valuation and, frankly, highly problematic insider signaling. I believe the structural weaknesses we saw in November fully justified the extreme correction.
Okay. So, focusing first on the fundamentals, we really have to recognize the dramatic decoupling between the company's operational execution and its share price. When we scrutinize the Q3 2025 results, we see unambiguous commercial traction that validates the long-term thesis. Revenue doubled year over year, hitting $3.7 million. This isn't speculative R&D funding, this is real-world adoption, validated by commercial contracts with significant entities like Davidson Technologies and the Italian government. It demonstrates actual use of their annealing systems today.
What's even more compelling for the long-term thesis, though, is the health of the unit economics. Gross margin expanded dramatically to 71.4%. To put that into perspective, that is a massive expansion of 1,560 basis points year over year. That margin profile is highly characteristic of scalable software and cloud service models, suggesting that their system is, ready to scale profitably. Furthermore, the capital structure is stronger now, not weaker. The recent warrant redemption, which was triggered after the stock price held about $18, successfully injected $54.6 million in fresh capital. This action cleared a massive capital overhang and provided the necessary liquidity runway for future R&D, critically supporting the dual-track annealing and gate model development path. These are the markers of a maturing company, not a failing one.
I appreciate the optimism in those operational figures, I really do, but I have to anchor us back to the market reality. While the fundamentals suggest operational success, the sheer volatility reflects deep structural and psychological risks that completely undermine that growth narrative, at least in the immediate term. We have to start with the obvious problem: valuation. QBTS trades at a premium price-to-sales multiple over 200x based on its peak November price, compared to even highly speculative peers like INQ at around 130x or Rigetti over 100x. When you price a company this high, it is inherently sensitive. Any slight crack in sentiment or shift in market rotation subjects it to massive multiple compression, which is precisely what we've witnessed.
Sure, but the growth is there to back it up.
But more critically, the decline was fueled by a severe crisis of confidence directly linked to insider activity. The CEO, Alan Barrett's discretionary sale of over $23 million worth of stock in November, utilizing options exercised at fractions of the current price, sent an undeniably and, I'd say, unforgivably bearish signal to the street. Irrespective of the company's internal metrics, the market views that action as management signaling that $28 plus is an exit price. And finally, we can't ignore the accounting noise that exacerbated the panic. While informed investors know the headline GAAP net loss of $140 million was largely due to non-cash warrant remeasurement charges, the media and retail just focus on that massive red number. This fed the easiest bear thesis narrative possible and just accelerated the sell-off dynamic.
Okay, let's dissect the warrant redemption event, because I think this is often misinterpreted as a negative. I maintain that the event was a massive net positive for the company's long-term health. The redemption was inevitable once the $18 trigger was met. It was a pre-planned event that secured substantial non-dilutive cash, $54.6 million, and, most importantly, it removed a huge liability from the capital structure. This short-term mechanical price pressure was simply the necessary cost of long-term structural health and balance sheet simplification.
I agree that simplifying the balance sheet is beneficial in theory, but we have to look at the immediate market mechanics and the disastrous outcome. I'm sorry, but I just don't buy that a healthy company allows its stock to fall 50% in the immediate aftermath of securing fresh capital. The redemption deadline on November 19th created intense, localized structural selling pressure. Yet two key groups selling. First, the arbitrage traders who held long warrant/short stock positions had to unwind, creating short covering demand and selling newly acquired shares. Second, and perhaps more importantly, were the retail warrant holders. Many opted for cashless exercises, meaning their brokers were forced to sell shares immediately into the open market just to cover the $11.50 exercise cost. This combination created an immediate mechanical supply glut. We estimate about 6.9 million new shares added to the float. That simply overwhelmed demand. This pressure is the primary rational explanation for the price collapse from 45 to 20. Regardless of the 71.4% gross margin you cited. This wasn't fundamental selling, it was structural selling.
But if it was a mechanical, short-term event, why did management not step in to provide stability or reaffirm confidence? If they truly believe the fundamentals justified a $40+ price, why allow the stock to be pinned at 20? The lack of any significant floor buying signal suggests management was, at minimum, comfortable with this new, much lower valuation.
And that connects directly to my second major concern, the poison introduced by the insider selling. I'm sorry, but I just don't buy that the CEO selling over $20 million in discretionary profits is simply benign diversification. That action, which was public and confirmed through SEC filings, created a damaging and I think irreversible public narrative. The CEO believes $28+ is the price to exit at. The retail investor base, which is crucial for maintaining the liquidity and premium valuation of speculative tech stocks like this, it relies heavily on confidence. When the leader takes massive discretionary profit, it eliminates bullish momentum and provides the justification needed for aggressive selling. This massive psychological blow fueled the final leg of the retail sell-off.
That's an interesting point, and I absolutely concede that the signal was undoubtedly bearish and it severely damaged sentiment. It was poorly handled in terms of public relations, regardless of the legality or personal financial necessity. However, I would frame the action differently in the context of the business's long-term health. We have to look at the forensic record. Bharat still retains millions of shares. It is a yellow flag concerning confidence management, yes, but it is not a death knell signaling the company's collapse. Furthermore, obsessing over one executive's personal tax and wealth management decisions distracts from the core strategic actions that address the primary existential threat to the business model. I'm referring to the dual-track technology pivot, the decision to dedicate capital to both their existing annealing technology and the development of a gate model system. That strategic action mitigates the risk of technological obsolescence, which is far more critical than an individual's trading pattern.
But even if we agree that the capital structure is cleaner, and that the CEO still holds shares, the way the stock trades the actual plumbing of the market, it still seems rigged against the bulls. Let's pivot to the market microstructure, because this is where many investors feel they are fighting an invisible, nefarious enemy. A core fear among retail traders is high dark pool volume, often interpreted as deliberate price suppression, and the numbers look bad. The off-exchange short volume ratio is consistently hovering between 40 and 45%.
We need to demystify this plumbing for the audience. I'm not convinced by that line of reasoning because while the volume is high, that 40 to 45% ratio is, well, it's pretty standard for high-volume, highly volatile tech stocks with large retail participation.
This activity is largely attributable to order internalization under the payment for order flow, the POFF model. When a retail buyer purchases shares through a zero-commission broker, the market maker is essentially selling that share short to the retail buyer and then immediately hedging that position by either buying a share in the open market or internalizing the order. This appears on short volume reports, yes, but it is flow management, not evidence of a coordinated short ladder attack designed to drive the stock to zero. It's simply the mechanics of retail trading, amplified by high volatility.
That's a compelling argument, but have you considered the options market structure? This brings us to a different level of control exerted by institutional players. The high implied volatility, or IV, ranging from 65% to over 100%, indicates extreme market expectations for large moves. But it also points to how the large options players, the market makers, position themselves. The options market is a powerful tool for controlling the spot price. We saw that the max pain point, the specific price level where the maximum number of outstanding call and put options expire worthless, thus inflicting maximum losses on speculators, it aligned eerily well with the final trading price of around $22. The market makers who write these options have a vested interest in seeing the price land at max pain to maximize their profits from expired premiums. The fact that the stock was repeatedly pinned near this level strongly suggests that technical factors, driven by the need of market makers to hedge and profit, successfully dictated the stock price, entirely independent of the operational success of securing contracts with Davidson Technologies or achieving 100% revenue growth.
The existence of a high max pain point near the trading price is a data point, but it doesn't prove manipulation. It simply proves that the options market is hedging against the volatility that the stock naturally exhibits. High beta stocks attract high volatility trading, and the option structure reflects that inherent risk. Let's return to the core issue of identity and valuation, which is the most difficult fundamental paradox facing D-Wave.
Exactly. The company is, frankly, caught in an identity crisis that confuses the investment thesis. Is it a profitable optimization company based on current annealing deployment, or is it a speculative R&D moonshot based on future gate model potential? This ambiguity amplifies its high beta nature. Investors struggle to justify a 200x PS multiple when the core annealing technology's ultimate utility is still debated against emerging gate model competitors. When sector sentiment sours or fear prevails, the drawdown is severe, reinforcing the need for caution, especially near the critical $20 support level. The market needs clarity on what it is paying for, current profits or future potential.
I'm not convinced by that line of reasoning because the existence of both facets, current revenue and future development, is precisely what justifies the valuation premium. Generating $3.7 million revenue today through genuine commercial deployments, coupled with that 71.4% gross margin profile, is exactly what differentiates D-Wave and justifies its higher multiple compared to peers that are almost entirely R&D focused. D-Wave has current commercial status, which few peers can claim. The strategic decision to pursue both annealing and gate model development mitigates the existential risk of technological obsolescence. The annealing segment provides the cash flow and proof of commercialization today, while the gate model path provides the moonshot upside necessary for the future. This dual path doesn't confuse the thesis. It makes it a sophisticated leveraged play that diversifies technological risk while capitalizing on its existing competitive advantage in commercial deployment. The risk of ignoring that 100% revenue growth and focusing solely on the structural price action is far greater than the risk of short-term volatility.
But is the $3.7 million revenue truly scalable, or is it limited by the niche applications of quantum annealing? While the margin is fantastic, the total addressable market for annealing solutions might be too narrow to ever justify a multi-billion-dollar valuation. If that revenue plateaus near $20 million annually because gate model systems take over the complex problem space, the current valuation is catastrophic. The question is not if they can execute, but what they are executing on, and whether that specific technology is the future. And that brings us full circle. The stock represents a convergence point where technological promise meets brutal financial mechanics. The high valuation makes it structurally brittle, and the market microstructure ensures that when it breaks violently. Investors must respect the technical risks,
even when the fundamentals show green shoots.
To summarize my position, the fundamental growth story, 100% YOY revenue growth, excellent gross margins, and a substantially increased cash balance, it remains fundamentally intact. The recent volatility was a temporary, mechanical digestion of capital restructuring and insider profit-taking, heavily exacerbated by market fear and superficial accounting noise. If the company continues to execute on commercial contracts and advance its dual-track strategy, this severe correction will ultimately be viewed as a necessary maturation phase that cleared away structural overhangs and created a healthier foundation for sustainable growth.
And while I acknowledge the improved operational execution and the benefits of the cleaned-up balance sheet, I maintain that investors must approach this stock with extreme caution. It remains a high-octane trading vehicle dominated by non-fundamental flows. The immediate price action, driven by warrant unwinds and options positioning, demonstrates that technical factors dictate movement. Investors must monitor technical support vigilantly. If the critical $20 level breaks, the downside is significant. We must remain critical of the extreme price-to-sales multiple and the susceptibility of the stock price to insider signaling and options market dynamics. Understanding the structural risks is just as important as understanding the commercial potential.
It is clear that D-Wave Quantum Inc. represents a unique and volatile paradox in the public markets, demanding an analysis that successfully synthesizes both corporate fundamentals and the chaotic realities of modern market microstructure. Navigating QBTS requires understanding that the story of quantum potential is currently being filtered through the plumbing of arbitrage, hedging, and sentiment.
Absolutely. Only by critically considering these multiple perspectives, the commercial reality versus the immediate trading mechanics, can one begin to truly understand the why behind D-Wave's turbulent performance in late 2025. It demands synthesizing the growth story with the volatility story.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.